Hello, Marc Ostwald from ADM Investor Services International with some thoughts this week on the Fed's policy framework review announced by Chairman Powell and what it implies and how it actually applies when one looks at the inflation indicators that not only the US publishes, but also those in Eurozone and Japan. So I have four charts this week. The first one is US headline CPI. As one can see, it's basically a case that inflation has been around a target other than in the last couple of months for much of the past couple of years. So this idea that the Fed is basically wanting to let it overheat, I would say, is something which they've already been doing. And I would also refer back to the previous video talking about how the fact that they're actually targeting financial conditions rather than employment and inflation as they purport to be. But that's by the by. I think the important issue here is that is basically around target. It will take quite a lot of work to get it back to target at the current juncture, given very disparate forces on inflation. And I would stress at this particular point that the important aspect here is we're not actually getting proper inflation data because data collection and data price formation is being very heavily disrupted, obviously, by COVID-19. But moving on, the Fed actually doesn't target headline CPI. So my second chart is what they basically look at in terms of, are we achieving what we want to? And that's the core Pce Deflator. Now, here the picture looks less good. As one can see, basically since 1990, so I've gone back 30 years, there's barely been any period where the Fed has basically had core inflation, which is basically the underlying inflation trend, anywhere close to that 2% target. For much of the time, it's actually been below it, barring a brief spike in 2018. So how does this compare elsewhere? Well, we can look across at the Eurozone to see how they're doing. As a reminder, obviously in the Eurozone, the ECB for the time being, though it is conducting its own policy framework review, aims to have inflation at or rather just below 2%. As we can see, basically, since the ECB came into place in 1998, for the first 10 years, they were doing pretty well around the 2% target. But since the global financial crisis, they have basically struggled for most of the time to achieve that 2% target, above all in the last 6 years. That's despite negative interest rates, that's despite all the QE. If that's a tale of woe, then perhaps we should look at my final chart, which is Japan's inflation rate. Which, as one can see, they are barring the sales tax induced hike in the 2014 period, 2014-2015 period. Basically, the Bank of Japan has never managed to get anywhere near. So the questions I would have is, A, are these inflation measures actually really worth targeting? Do central banks actually have any control over them? Or are they merely tilting at windmills? And thirdly, if we do, if markets react positively to central banks allowing inflation to run hot, the real question is, will they actually get anywhere close to it, given that the past 5 to 10 years, none of them have really achieved what they actually wanted to do? Just some questions to think about. And those are the thoughts for this week.